Hello friends, welcome to Learn Easy. We will discuss inventory valuation method. Let us see what inventory is meant for. The term inventory implies the goods available with the business enterprises as the excess supply of goods, which is helpful in keeping the operations going without any delays or shortage of stock. Inventory to be maintained in three stages. First, raw materials. It refers to the unprocessed supply of material which serves as the main component for the goods to be produced but seems excess at that instant. Second, work in process. Work in process implies the partially completed stock lying with the organization. Third, finished goods. These are the goods ready for sale. Now, inventory valuation is the method of identifying the actual value of the inventories at the end of the year. The main objective behind the valuation of inventory is to determine the true income and true financial position of the company. One request, if you are new to my channel, please subscribe, share and press the notification bell. Inventory valuation methods may be classified in two steps. First, historical methods, and second, non-historical methods. Then, historical methods may be of five forms. First, specific identification method. Second, FIFO, first in, first out. Third, LIFO, last in, first out. Fourth, simple average method. Fifth, weighted average method. Non-historical methods may be of two categories. First, adjusted selling price method, and second, standard cost method. Specific identification method. In this method, the price of goods is determined on the physical flow of goods. Specific costs are attributed to the recognizable goods. It involves sorting various lots bought separately to ascertain the lot, whose specific purchase price forms the basis for their historical cost. Second inventory valuation method is FIFO, first in, first out. FIFO method is an inventory valuation method in which the cost of goods sold COGS is based on the cost of the oldest inventory items. The remaining inventory is valued at the cost of the most recent purchases. This method assumes that the first items purchased are the first items sold. That is why it is called first in, first out method. Let us see an example of FIFO valuation. Let us assume a business bought laptops at different timing and prices. First transaction, 10 laptops at the rate rupees 50,000. Second transaction, 5 laptops at the rate rupees 52,000. At the end of the month, the store had sold 8 laptops. With the FIFO valuation method, costing is calculated from the first transaction when the user purchased 10 laptops at rupees 50,000 each. So, after selling 8 laptops, accounting balance for COGS, cost of goods sold, is equal to 8 laptops into rupees 50,000 each is equal to rupees 4 lakh. Inventory is equal to 2 laptops from the first purchase and 5 laptops from the second purchase. So, accounting balance of inventory account is equal to 2 into rupees 50,000 plus 5 into rupees 52,000 is equal to rupees 1 lakh plus 2,60,000 is equal to rupees 3,60,000. FIFO is suitable for first manufacturers with consistent or decreasing pricing. These may get benefit from FIFO's accurate COGS. Businesses with stable or declining prices use FIFO, as for example retailers, wholesalers and representation. Second, businesses of perishable goods, as for example grocery stores, pharmacies, and restaurants dealing with expiring items rely on FIFO to minimize spoilage and maximize freshness. Third, businesses complying with IFRS, International Financial Reporting Standards. Companies operating in regions requiring IFRS adherence must utilize FIFO for inventory valuation. FIFO should not be used in businesses with volatile pricing and companies prioritizing tax minimization. Second, industries with fluctuating prices, as profitability may be distorted by FIFO. Third valuation method, LIFO, last in, first out. The last in, first out LIFO method is an inventory valuation method in which the cost of goods sold, COGS, is based on the cost of the most recent inventory items. The remaining inventory is valued at the cost of the oldest inventory items. LIFO method assumes that the last items purchased are the first items sold, which is why it is called the last in, first out method. To calculate COGS, cost of goods sold, using the LIFO method, the cost of the most recent inventory items is matched with the revenue from the first units sold. As new units are sold, the cost of those units is matched with the revenue until all inventory is sold. The value of the remaining inventory is based on the cost of the oldest inventory items. LIFO valuation example. One request. If you are new to my channel, please subscribe, share, and press the notification bell. Let us assume that a business bought laptops at different timing and prices. First transaction, 10 laptops at rupees 50,000 each. Second transaction, 5 laptops at rupees 52,000 each. After selling 2 laptops, accounting balance for COGS, cost of goods sold, is equal to 2 laptops into rupees 52,000 LIFO cost is equal to rupees 1,04,000. 10 laptops are still left from the first purchase, cost at rupees 50,000 each, as well as the 3 laptops from the second purchase at rupees 52,000 each. So, accounting balance of inventory account, 3 laptops at rupees 52,000 each plus 10 laptops at rupees 50,000 is equal to rupees 1,56,000 plus 5 lakh is equal to rupees 6,56,000. LIFO is suitable for first, businesses with rising prices. Considering LIFO's tax benefits, industries which experience rising costs like manufacturing, oil and gas, and construction should use LIFO. Second, companies focused on short-term cash flow. LIFO's potential tax savings can be advantageous for businesses prioritizing immediate cash flow management. Third, entities operating in non-IFRS region. LIFO is viable option for companies outside IFRS, International Financial Reporting Standards compliance. LIFO is found to be a viable option. Again, LIFO should not be used A. in businesses with stable or declining prices because it can distort profitability. B. in businesses seeking long-term financial transparency. C. entities using LIFO would be non-compliant and lead to legal and reporting issues in companies operating in IFRS region. Fourth valuation method is WAC, weighted average cost. The weighted average cost WAC is an inventory valuation method in which the cost of goods sold COGS is based on the average cost of all inventory items. This method takes into account the cost of all inventory items purchased during a period and the average cost per unit of inventory. To calculate the cost of goods sold COGS using the WAC method, the total cost of all inventory items is divided by the total number of inventory items to calculate the average cost per unit. This average cost is then multiplied by the number of units sold during the period to determine cost of goods sold COGS. The value of the remaining inventory is based on the weighted average cost per unit of all inventory items. Weighted average cost WAC is suitable for first, businesses with steady purchase prices. WAC shines when purchase costs remain relatively stable, avoiding significant distortion in COGS calculation. Second, companies with diverse inventory compositions. For businesses offering numerous variations of the same product or frequent purchases with varying prices, WAC simplifies cost management. Third, entities seeking simplified record keeping. WAC's efficiency can be advantageous for businesses prioritizing streamlined inventory management and reduced administrative burden. WAC should not be used first in businesses with volatile pricing. If our industry experiences frequent price fluctuations, WAC's average cost might not accurately reflect the true COGS and it distorts profitability. Second, in companies requiring precise COGS, if precise cost calculations are crucial for the business decisions, FIFO or LIFO might offer better accuracy than WAC's blended approach. Third, in entities needing to track cost trends, WAC can mask underlying cost variations, making it less suitable for businesses needing to identify and address cost-saving opportunities. Fourth, in businesses managing perishable goods. For industries like food or pharmaceuticals, FIFO's focus on selling older items fast could be more appropriate than WAC's average approach. Let us see an example of weighted average cost WAC. Let us assume a business bought laptops at different timings and prices. First transaction, 10 laptops at rupees 50,000 each. Second transaction, 5 laptops at rupees 52,000 each. So, cost of total 15 laptops, rupees 10 into 50,000 plus 5 into 52,000 is equal to rupees 5 lakh plus 2 lakh 60,000 is equal to rupees 7 lakh 60,000. So, our weighted average cost is equal to rupees 7 lakh 60,000 divided by 15 is equal to rupees 50,667. After selling 13 laptops, accounting balance for COGS, cost of goods sold, is equal to rupees 13 into 50,667 average cost is equal to rupees 6,58,671. Accounting balance of inventory account is equal to 2 laptops remaining into rupees 50,667 average cost is equal to rupees 1,01,334. In simple average price method, the different prices of all the batches are aggregated and then divided by the number of prices. This will give us a simple average price for all the lots. The closing stock is valued at the average price determined. First non-historical method is adjusted selling price method. Adjusted selling price method is mainly used in retail businesses, and so it is called a retail inventory method. This is suitable for measuring those inventories that has a high number of frequently changing items with the same margins. Under this method, the cost of inventory is calculated by reducing the anticipated percentage of margin from the inventory's sale value. Second non-historical method is standard cost method. In standard cost method, a standard cost for the inventory is ascertained on the basis of experience as per the rapid changes in the price and frequent purchases. Now let us conclude. Inventory valuation is an important aspect of business accounting that allows us to accurately track the value of our inventory and calculate cost of goods sold. Several methods available for inventory valuation include FIFO, LIFO, WAC, specific identification, simple average method, adjusted selling price method, and standard cost method. Each method has its own advantages and disadvantages, and businesses should carefully consider the specific needs and accounting requirements when choosing a valuation method. That's all. Thank you for watching the video.